Hi everyone and welcome to NK Real Talks. Today we got Zac here, which we had almost a year ago, right?
No, full circle. We've
Full
come all the way back around.
Yeah,
That's
back
it.
in the day we were calling it webinar series. Now we're actually calling it the NK Real Talks. We're gonna talk about what's happening in the market, especially one of the best mortgage brokers here. So we want to know what the mortgage environment has been, especially after the latest hike.
Yeah, it's definitely changed for people on those variable and adjustable rates since the 12 months ago that we were speaking.
I can relate to that right now.
yeah, me as well. And all my clients, right? A lot of the time, at the time, it made sense. Yeah. Based on what we were forecasting, what the Bank of Canada was forecasting, what the rate hiking cycle was going to be, that it made sense for these clients to take it. The affordability was better, either that fixed variable payment or the adjustable payment. And now, obviously, people are feeling the repercussions of that hockey stick increase by the Bank of Canada over the last 12 months. Since we last talked.
So while we're talking about that, so that trigger rate has hit for the majority of the people, I'm guessing, at this point, right?
Yeah. So the trigger rate, for those that aren't aware, is when you have a fixed variable payment, so a static variable payment where your prime or your mortgage payments do not change when the prime rate changes, just the principal and interest within the loan. So when that becomes a 100% interest payment or goes beyond that, the bank says, hey, you're not paying us any money. Technically, your amortization is infinity. You're never going to be able to pay this loan off. So you have to go back to the bank, or the bank's going to reach out to you and say you got a couple options. One being increase your payments. So you're actually giving us some money towards the principal. Lock into a fixed rate, which for a lot of people, if they had that static variable, we're still at $2,000 a month on a $500,000-$600,000 mortgage. Where if they took that fixed rate right now, they're going to jump up that $1,200 that the adjustable people have been feeling slowly, but they're just going to get it all in one hit. Right? Yeah. So, I mean, the options for most people were to increase the payments, and I think that's what a lot of people did, because a lump sum payment and say, here, bank, take $5,000 isn't really a feasible option for a lot of people. But increasing the payment just to kind of get by until the next rate increase was kind of how a lot of people
I actually just had a call from just walking here. Someone just comes like, what just happened? Like, did they increase the interest rate? Because I think you just got a call from the bank. So a lot of people are actually feeling it. But when it goes down to renewal, is it a wise option to renew with the same bank, or go shop around and see what you can find?
It's always good to shop around, right? It's always good to speak with a mortgage broker and look at your options, because the bank's just going to offer you whatever that renewal rate is on the table. And right now, 9 out of 10 times, we're going to be able to beat that renewal rate for sure. Because the banks are coming in very high, very aggressively. One, trying to make back some of the money from all those super low interest rates, right? So that's what I assume is part of the plan there, is to make some money back. They're always going to want to lock you into a 5-year fix, because that's where they make money. And we can talk about that in a second, of where the 5-year fixed are at and why banks are kind of pushing that agenda again. But it's always good, to speak to someone on renewal, because it just gives you more options. And if you can qualify, then why not move over to a lender? There's no
that's
penalties.
exactly, I think, the key word, if you qualify, because I feel like a lot of people qualified back then. They got the mortgage, and now things have changed. They either don't qualify, or their job is not the same, so the income is less. So I feel like, do you see people not changing banks because they know they're not going to get qualified?
That's really the main reason you wouldn't shop around or look around, right? Or we put together sort of a pre-approval for you on renewal, right? And see what you can qualify. If it's not going to work, then it's like, okay, take that renewal and run, because we can't actually move you right now, right? You have to stick with that lender. But in saying that as well, right? Like, renewal options give you an opportunity to potentially restructure your mortgage, like do a refinance without paying a penalty, because you're not breaking anything. You're at the end of your term.
Right.
So one strategy that I use with a lot of clients, or just propose to them anyway, is if they're at a 25, a 20-year, 15-year amortization, let's look at bringing it back to 30-year amortization. Now, a lot of people are like, Zac, I've paid down my mortgage for 10 years. I don't want to go backwards to 30. But they don't realize that you can refinance or re-amortize the other way as well. You can shorten your amortization at any point with a lender. You can basically just talk to them.
Or your payment drastically goes up higher.
Exactly. But for right now, for cash flow or qualification purposes, it could allow you to get a better interest rate somewhere, help your cash flow out, because everything is more expensive, inflation and all that. And then say in 2 years, 3 years, you're in a better situation, knock it back down to 15, right?
So right now, like, if you were to go qualify, let's say like you were 25, you're down to 20. what's the maximum you can go to?
So 30-year on traditional A lending with lenders. On the B side and alternative, you can go 35, 40, but banks are kind of cutting away at the 40.
But I'm guessing like if you go 35, the rates kind of go higher, right?
Everything on the alternative space, when you get to bend the rules a little bit, you're going to be paying a premium. So I'd say 1.5%, 2% higher, depending on credit and the property and the.
What about between 25 and 30?
Yeah,
in the banks.
25 and 30-year amortizations do come with generally a small premium between that, maybe like a point, 10 basis points, 0.1%, or depending on the lender dependent as well. Because a lot of the times you can get exceptions as well, which could then drop the rate down depending on your.
And then you got to requalify if you're changing that draft.
If you are even with the same lender, right? Yeah. So because now you're not just taking that renewal letter and continuing on with the mortgage that they that had set out. Now you're restructuring your whole loan. So it is a brand new mortgage. You can consider it as a new mortgage paying out your old mortgage.
Got it. Okay, that's a good question to ask because like a lot of people that I'm dealing with, they are feeling the pinch. And when I tell them like, listen, if you're staying with the same bank, go increase the amortization, which a lot of people don't know they can do. But that's a good point to mention. For people who are buying right now, if you're not getting qualified, or even if you're getting qualified with the A lender, first, what are the options with the A lenders in terms of rates? Two, if you were to go with a B or private, what are the rates like?
Yeah. All good questions because it's important for buyers right now. All they hear on the media is that the rates are incredibly high and it's hard to qualify. So right now, we see the adjustable variable rates, they are much higher, about 1%, say 0.9 to 1% higher than where the fixed rates are sitting on those 5-year fixed rates. But I always am weary to suggest or recommend a 5-year fixed rate to people that are not dead set in stone that they're going to stay there for 5 years. And there's a really big, I'd say, issue with taking a 5-year fixed right now because in 2 years, let's say rates do come down and they're cut in half and you take a very attractive 4.5% 5-year fixed rate, which is good. It's a good rate comparative where the rates are at. But now the posted rates in those banks are going to change, that 3-year post rate. So now you're 2 years into a mortgage, you see the rates are now down at say 3% or the high twos again, hopefully, let's just say. But then you want to refinance or get out of that mortgage, it's going to be an astronomical penalty because they're going to structure the way that you're breaking a mortgage 2 years in. They can adjust those rates from the bank at however they see fit, which will affect your break penalty, right? So even though you're signing on the dotted line now for a break penalty, if the bank internally changes its rates on a 3-year, then it's going to cost you way more money to get out of that and refinance. So even though right now that 5-year fix looks good, taking a 2 or 3-year fixed rate is kind of what I'm more suggesting to my clients right now, which is higher. It's going to be in the 5% range sort of deal as opposed to 4.5. You're taking 50 basis points is a big jump, but you got to think about 2 years down the line and the, net cost savings that are going to affect you.
Because you're going to be drastically paying for, like, let's say another extra 2 years.
Another 3, 2,
hopefully
3.
they're not staying as high.
Yeah.
But would you, like right now, for 1, 2, or 3, or 5, what are the fixed rates hovering around?
They're different depending on the type of property, right? And the amortization, like you're saying, 25 or 30 years is going to be different. And an insured purchase, so less than 20% down, less than $1 million are going to be your lowest interest rates, which I just got an exception for someone. We didn't end up going with the product. They just wanted to see what the lowest 5-year could be, and we were actually able to get them like 4.34% on a 5-year fixed, which is incredibly low out there, right? It's a fantastic rate in comparison to where the rates have been, and then showing them, okay, here's a 2 or 3 year up at 4.84 or 4.89 and like 5.9 or 4.99%, so close to that 5% plus range. But weighing all those pros and cons with them, I'm saying, we're going to likely save you money by you paying a little bit more in interest right now. And then when you break down into dollars, because I think percentage-wise and interest rates always screw with people's heads. They just want the lowest. They just want the lowest. But when you break it down and say it's only $80 a month or something, right? And then it's like, can you sacrifice that extra $80 a month to potentially save you thousands and tens of thousands in the future?
Would you recommend a 1-year fix?
Not necessarily, because based on what the predictions right now, and the articles are out, and the predictions from those top economists and the CIBC economists that I was just reading about actually before we were doing this. I'm not sure, but it was
it's probably one of them.
Yeah. But saying that their outlook was the end of 2023, even as soon as like October, maybe we'll start to see some rate cuts from the Bank of Canada. Now it's likely that we're going to see it plateau for all of 2023 and start in 2024. So if you're getting a 1 year fixed rate right now fixed rates are different from adjustable and variable in how they're calculated. They're not actually determined by the Bank of Canada. It's the 5-year bond yields, right? But so that being said, it's two separate categories. But saying that, rates are high, they're always going to fluctuate around the same, right? They're going to come down sort of together. So if you're taking a 1 year fixed, you're just going to be kind of renewing back into the same environment, and you might need to take another 1 year fixed to then finally get to a lower rate environment on renewal.
Good. So that's with the A lenders. And in terms of someone like starting out just wanting to like get into the market right away, if they don't qualify easily with the A lender, the options with the B lender and the let's say the privates are those options.
So alternative lenders and B lenders, I like to say alternative because I find B's got the negative connotation. No one wants to be a B student, you know what I'm saying? So the alternative lending out there is generally always going to be, 1 to 2% higher on the interest rate, and then you have a 1% fee on the mortgage amount.
Right.
So that's what you're always looking at. Now, it depends on the type of client, right? If you'd have to have 20% down, right? So someone that has more cash kind of in the game. And for me, it's I work with a lot of self-employed or incorporated individuals as well.
Right.
So those are where those types of loans are actually going to benefit those people, right? They're coming up to tax time right now, and I work with a lot of accountants to kind of go over people's incomes before they actually file them away. Because I like to look at how much money do you need to actually claim, and then you're going to pay a crap ton more in taxes, right, to be able to get in with an A lender, or we pay 1.5% higher interest rate and a fee, but you can write off all that stuff that you normally would write off. So it's actually like more beneficial for some people to stick with that alternative lending space, whether they could potentially qualify, but do you want to pay 20, 30 grand more to the CRA?
Because the tax savings outweighs the interest.
Exactly. Or do you want to pay 4 or 5 grand
to this lender? That's actually a really good point.
Yeah. So it's like, and that's what you always have to look at that's why I call it the net savings on everything. Because people always focus, I want the lowest interest rate. I don't want to pay any fees.
But then you got to go pay the taxes on it.
Then you got to pay the tax man anyway. So it's like you're paying that out of, paying left or right pocket, however it's coming out.
So it comes down to like if you want to pay it kind of up front or you want to pay it gradually over a few months.
Exactly. And you can always, if you're going into those alternative products, because a lot of them, speaking to the 1-2 year fix that we were talking about, a lot of them are generally just 1 or 2, 3 year fixed. They actually don't operate a lot of them in the 4 or 5 year fixed rates. But if you know that you're going to be in that alternative lending space and you don't want to claim more of your net income and pay more taxes, then you can plan for that and take a 3 year fixed with these alternative lenders where the rates are actually going to be lower because they know you're sticking out longer with them, right? It's not just a 1 year solution to then move to an A lender, which is a lot of great strategy for people that don't qualify right now.
I see that a lot.
As you were talking about, short-term B, and then we flip it over to the A lender, right? So different strategies for different folks there. It always depends on the client with the alternative lending, but
I see Nick taking some pointers back there. Nick, are you purchasing something?
I might be saving.
We're getting him pre-approved right after this. Actually, we're sitting down. It's
like maybe
off
I
camera,
should be doing
off camera.
Maybe I should be doing some B lending. So, for in terms of private, what's happening with those?
So private rates are definitely higher, and it's mainly because like I work with a fair amount of people that are either just borrowing to lend, right? They have a HELOC. They're individual like private lenders, just individuals that lend money for small deals, 50, 100K, seconds, and things like that. They're traditionally a little bit more safer, secured with a bunch of equity. And if they're borrowing their money at a HELOC at prime plus 0.5% right now at 7.2%. Well, they have to make a couple points off it, so it's 10, 11, 12% plus, right?
Yeah.
It does drastically depend on the property, right? Like I just did a private, a large private on a $2.5 million home, and it was only at about 50%, right? About $1 million private on there. They got a pretty decent deal, right? I believe it was about 9% and very low fees.
Right.
But that's because it's secured. They have a lot of equity there. It's a very secure investment for the private. So really, it always depends on the property when it comes into that space, because as long as they can make the payments and they cover those, or roll the payments into the mortgage or however it's structured, then it doesn't matter. They're willing to take a few points less because it's such a secure, safe investment for them.
Got it. Yeah.
But I also work with investors that are, taking on small private investors at 15%, right, and paying that off.
Because it depends, like, how much funds they have, I guess, available and who's taking
It's
what.
the liquidity with the lenders as well as the property. The area is very important.
And if they're first or second or third as well.
Exactly. And right, it comes down to marketability as well with the property. If it's at somewhere super northern Ontario, it's maybe a little bit more difficult to sell. If it's right downtown Toronto condo with very little mortgage on it, that's an easy deal for a lender. They can flip that and see you later.
Amazing.
Right?
So right now, like, let's say on average compared to last year this time, how much do you think affordability has dropped on a, let's say, like $3,000 monthly payment?
Yeah, I mean, definitely a lot. And it's really just that stress test, right? Because we were qualifying everyone with, when the rates were 1%, it was 5.25 all day long. That's what we were qualifying people at. Now the rates are at 5%.
And what's the qualifying rate?
Now you're at the contract rate plus 2%. Wow. So now we're qualifying people at 7%, 7.5%, right? Like that's where they're sitting, especially on refinances, which are traditionally high, a little bit higher interest payments. So it's 5.5%, let's say. Now we're qualifying at 7.5%.
Got it.
So that is a big jump in qualifying
and
rate
that
from 5
drops
to
down
5.
your purchase price.
Drops it down.
But one thing that's really interesting is that we ran some numbers and we saw that actually right now, especially with the January numbers that came out, in majority of the areas, mostly in York region and Peel, if you were to buy a detached last year, this time with the low rates, you would be paying more monthly than you would be paying right now because of the drop in the prices.
And that's it, right? The one thing that I always say to people that are on the fence right now, depending on, the interest rates are high, so we want to see what happens, or we want to see the prices go lower. You can't change the purchase price that you bought it for and that principal mortgage amount. Right? That's always, so the people that had a $1 million purchase with an $800,000 mortgage 12 months ago, they're paying off that $800,000 mortgage. If you can get it at $800 with a $600,000 mortgage, 12 months later on a very similar property, you guys are starting at $800 and $600,
that's a
right?
huge,
So
huge drop.
Exactly. So you're paying off that from $600,000, and in 5 years, when the rates change and you're in a different environment, you're going to be ahead of that person with a much larger mortgage amount.
And if anyone is looking for actually doing the math, contact us because we ran the numbers. And not only you save on the actual purchase price, you're carrying a lesser mortgage and your land transfer tax is drastically lower. So
that's the closing costs on it as well. So the down payment, the closing costs, the actual principal amount of the mortgage, everything is less.
So technically it's a good time to buy.
It is.
So why is no one buying? But again, right now the problem we have with majority of the areas is the lack of inventory. And what we've seen in the last 4 weeks, especially like right after January hit, most areas didn't have enough inventory, especially in the detached segment. So we saw if properties came that were priced well, you'd get multiple offers on it. And this goes all around town, like York Region, Richmond Hill, Aurora, Mississauga. We had a listing in Mississauga, hit the market 6 hours into the listing, 6 offers on it. And it just like blew up. Again, reason being, it was a good product in a nice area and there wasn't a lot of competition around it. And people in the market, people still need to move. They still need to buy properties. So it made it affordable for them. Same house probably last year would have been unaffordable for majority of the people that are buying right now because it was sitting at probably around 1.5, 1.6 million.
So do you think there would be any sort of shift towards the seller's market kind of coming back, or those multiple offers or no conditions? Do you think that's going to be happening again?
So right now we're seeing that. We're seeing that across town, Toronto, Richmond Hill, Aurora, Mississauga. Like we're seeing it right now in Oakville, which was for the last 4 months saturated with detached properties. If a property comes on the market, and usually these multiple offers are happening below what I'm seeing, below 1.5 million generally. I mean, like in Toronto, if you got a property that's 1.8, you get multiple offers on it. But so we have that right now. We ran into it in Oakville. I ran into it a few days ago in Toronto and Parkview Hill. And in Aurora, I'm seeing it that a lot of properties that need to sell, they price it in the low millions and they get multiple offers on it. It's not to say it's going to drastically go over asking like what we saw last January, but still, if it's a good product, it will go because not enough inventory out there. And majority of the inventory that we see on the market is either condos or homes that are not priced well, or like we call them like the stale inventory because it's priced wrong. It's not fit for like living or whatever it is. It's essentially comes down to the pricing it. And they're sitting on the market for the last 3-4 months. So with that being said, I think going into, let's say, the first quarter, I think inventory is going to rise. But as I see, prices have plateaued, and I'm seeing in the detached market mostly that the prices are starting to rise again. And this has started around Christmas that I saw, lack of inventory, and the homes that are selling higher than the ones that sold previous to that. But prediction-wise, I would say we're around the bottom, unless something drastic happens.
I would agree that it would be maybe a small little bit more decrease as the interest rates are plateauing as well. So we might see a little bit more, but definitely
And I have a feeling as soon as they say, okay, we're not raising the interest rate, because right now there's talks of it, but I guess no one knows what's going to happen in March next.
There's actually they doubled their prediction of there being a 0.25% increase, but that still is only a 20% chance. That's what they're saying. There's 20% chance that in March 8th we see another quarter point increase. So very little. Basically,
compared to what we went through, though, right?
Yeah, and comparative, there was like a 95% chance we're going up every single time.
Exactly.
So 20% sounds pretty good.
So with that being said, not enough, I would say not a whole lot of interest rate increase coming down the pipeline. And with the lack of inventory that we see, and there's a lot of people migrating to Toronto, GTA overall, I don't see the prices going any further than this. And I think if you're selling right now would be a good time to sell, because not a lot of inventory. If you're buying, there are all deals out there that if you can close quickly, you would be in a position to get it for a much better price.
Right.
In terms of your predictions going, let's say, first quarter, second quarter, what do you think the maximum we could expect to see in terms of interest rates?
Yeah, so it's hard to say with the fixed rates right now, because the bond market has been. We did see in January the low of 5 months, a 5-month low, which we actually 5 months before that we did see a similar kind of drop in those fixed rates, especially the 5-year, because we're dealing with the 5-year bond. But overall, the fixed rates are down. Then we saw them climb a bit and now drop again. And then even as of yesterday, we're filming this on Tuesday, on Monday, the February 5th, I believe it was. So just
first week of February,
so
because this is going to be kind of irrelevant in March.
and it could be next week, though, because we're seeing this kind of volatility with that. So lenders drop those fixed rates heavily. But now with that slight increase, we've seen a 5, 10, 15 basis point increase as well to the fixed rates, where the variable and adjustable, we know kind of where they're going to be. So it's actually more stability with that. And the fixed rates are actually now going to determine the real estate market more as a whole. Because if those are fluctuating more often, that's how people can now qualify for more. You take a variable rate right now and you have to qualify at 8% with the stress test, or you take a 5% fixed rate or lower than that, so you can actually afford more as opposed to 12 months ago where you'd wanted to take that variable rate because your payment was peanuts. It was nothing.
Exactly.
Right?
Exactly.
Now the affordability comes from where the fixed rates are going to move. So to make an accurate prediction is hard. I'm hoping we still see the downward trend of the 5-year bond like we've seen over the last 3 months, kind of trending downward, and that bottom that we saw in January. So if that continues, then we'll see it stable or drop even further from where
and in terms of the actual prime rate, do you think like
prime rate is going to
0.25 or?
I would say it's likely that we're going to hold steady. The U.S. just rose the Fed rate there on Monday as well, I believe, by 25 basis points. So we normally follow suit with them, but we've seen some conflicting articles of the U.S. saying we've beat the inflation too quickly, or we've beat the inflation already.
We're gonna put a pause on that.
So it really just matters. Like there's a jobs report that comes out on Friday. Like Canada is reactionary always, the Bank of Canada. So we have to see what comes out. The jobs report, the economic report, the inflation rate, exactly. All of those things are going to determine what they actually do. But I'm thinking, based on most of the predictions and the economists out there, that we're going to see a plateau or a stability for 2023.
That's amazing. Well, I mean, Nick, we put an order in for a crystal ball, right?
That's delayed.
Delayed,
So
okay. We're gonna get that. Hopefully, figure that out.
We'll have it right here next time, and we'll check to it, see what it says.
Yeah. But again, Zach, anything else to add?
I think that's it. I think we covered a lot. Thanks for having me again.
Thank you for coming.
Yeah.
It's so nice that this guy, every time he talks, I just want to renew my mortgage. Like, holy.
That's what I do. I don't know. That's what people say. Yeah.
But again, thank you. Like the knowledge that you drop every time, like I talk to you, especially because people are scared to get the mortgage. But when you hear there are options out there and alternative lending is not as bad as it sounds, especially when you put it in the perspective of, like, how much tax you gotta pay sometimes.
How much money you're actually saving.
Yeah,
Like,
it could actually make sense for a lot of people.
Yeah.
So that's something to really consider if you're trying to get in the market and, a lender is not your best option. Again, be sure to get in touch with Zac for any questions you have. And if there are questions, comments, we'd love to hear from you. Leave them in the comments below. If you find this episode useful for yourself, friends, be sure to click that share button, click the subscribe, and we'll see you on the next one. Have a great day.